In the 75 years since India's independence, the mix of our savings and spending habits have changed, but not to the degree that one would have imagined. Most remarkable, of course, is the change in the last 2 years, which has seen record flows into the domestic equity market. But barring that, Indians have held an affinity to primarily two asset classes. Indians have always held a massive affinity to physical assets, real estate and gold. Indians' love for gold is unparalleled in the world. Since independence, the yellow metal has shown an appreciation of 54,000% in rupee terms. In 1947, 10 grams of gold cost 88.60 rupees, a figure which is unimaginable when compared to the high of 60,000 rupees in 2020 and even the current prevailing rate of around 53 to 54,000 rupees. According to experts, the function of gold is to act as a portfolio hedge and should not exceed 10 to 15% allocation. However, according to the World Gold Council, Indians have amassed about 25,000 tons of gold, putting Indian households in the league of many central banks in the world in terms of gold reserves. While gold has been available in paper form for many years now, but the share of paper gold versus the physical form still remains minuscule. This is despite experts overwhelmingly voting in favor of paper gold as a superior form of investment. The other asset we favor disproportionately is real estate. But this wasn't so in the early years of independence. Prior to 1980s, Indians barely held any substantial land or gold. There was absolute averseness to taking on debt of any kind, even if it meant for investment purposes. Not to mention that incomes too were quite limited. If one wanted to, say, buy a house, they would first save up the entire corpus required and then make a down payment. But in the late 1980s and early 1990s, the trend started changing. The bull run created by Harshad Mehta caught the fancy of many. Many retail investors also made their first big money from stocks around then. But looked at in the context of an entire country, the real number of investors were barely a ripple. Roughly around this time, a love affair with real estate too started. Equities were still considered a risky asset, and any gains made here would be quickly transferred into buying a property, if not gold. The large flows into real estate also created a boom period for that sector. After stagnating for years, realty prices were moving almost 10% annually. The subsequent crash in the stock market, once the Harshad Mehta scam broke, also brought a lull and subsequently a sizable drop in the property segment. From this period of the early 90s all the way to early 2000s, the property segment stayed depressed. But the entry of IT companies at the turn of the century once again provided healthy salaries and bank balances which could feed our love for real estate. By 2010, the aspiration of any middle-class family was to own their own home. There were several boom and bust periods for the Indian property sector, but nothing has still dimmed our desire for our own home. Several reports pin the share of real estate and gold as a proportion of Indians' wealth at upwards of 90%. Just like with gold, the paper route to invest in real estate is now available in the form of REITs, but this has also to pick up substantially. Retirement planning still remains a negligible area of concern, primarily due to informal arrangements between family members. Wealth is bequeathed to the next generation, and in return, care is provided in the retirement years. It is for this reason too that compared to the global trend, where debt is particularly high in the early earning years, Indian households tend to borrow later in life and are more likely to reach retirement age with positive debt balances, ordinarily considered a risk event. But in India, it continues to work. But the shift to financial savings is pretty visible now, especially since 2019 when we saw the onset of the pandemic. In 2019-20, Reserve Bank data shows that household financial savings have risen to 16.81% as a percentage of GDP, of which over 21% is flowing to financial assets, while 5.38% is going towards financial liabilities. The aggregate flow is almost 3% higher than the previous year and has more than doubled since 2017. The primary reason for this jump in savings is because avenues of consumption were themselves limited. The 2 years were marked by partial and complete lockdowns, and spending naturally suffered. The more heartening reason, though, is that many have also increased savings and/or investments with an eye on adding to their emergency funds. Of this 21%, the largest chunk, which is 52.7%, is still in the form of commercial bank deposits, a little over 23% in insurance, and a small amount, under 7%, in mutual funds. In terms of liabilities, loans from banks account for 3/4 of the pie. But the shift to financial savings looks to have turned the corner. In the last 9 months, when foreign portfolio investors net sold Indian equities every single month, it was the domestic investors who saved the day, something we should see more of in the years ahead.